Okay, YouTube boleh. Saya check YouTube. Oh, banyak kartun. Ini anak saya. Okay, tu ada ni. Okay, okay. Bismillahirrahmanirrahim. Okay, so for today, I'll be actually discussing about the uh, portfolio investment objectives. Okay, the objective of portfolio investment. All right, so um, I have what 100 slides, but I will go bit by bit, and then we have to have like two-way communication so that we can understand better, especially for the students from Middle East. Okay, but um, this is a learning process, right? So even though you are from not from finance or from what you call it economics, you still need to invest um, your money, right? So this is a learning process for you to become more um, what you call it financially literate, okay, and also to grow better in terms of financial, right? Okay, nevertheless, okay, the wealth is not everything, right? So we have to have this what you call it the dunya akhirat. So the wealth is for your for dunya, right? But also can be used for the hereafter. So basically, you need to be wise in actually investing. Okay, and investment not only investing to make your money, to make money, but also to make pahala. Okay, to make pahala, to make rewards for our day hereafter. But in our class, we will discuss more on the what you call it, how to make money. Okay, how to make money. But at the same time, okay, don't forget, okay, because you are all from Middle East kan, from Jordan, from Al Azhar, so basically kadang-kadang ingatkan saya, kan. Kadang-kadang lagu tu, kan lagu dunia tu kadang banyak sangat. Alright, so the objective discussed by portfolio management should be considered a process. Because basically, portfolio management is actually a process. There are steps that you need to go through, right? In the steps, for example, you have to have your objective first. You know what is your objective, right? And then you need to do some analysis, okay? Analysis of the securities that you. And then describe the step involved in portfolio management process and then assess related issues such as asset allocation. Asset allocation is actually you want to put how much is your, let's say you have 10,000 ringgit, so where do you want to put that? Okay, where do you want to allocate your asset? Right. Okay, but when we talk about asset, right? Okay, when we talk about asset, uh, what do you know about the definition of asset? What do you know about assets? Something valuable, right? Technically bring profit, okay? Can be measured, okay? All right, okay. Can help us when we can be used when we are in difficult times. Okay, liquid or not liquid, all right. So in terms of liquidity, right? You know what is liquidity, right? You know. Okay, all right. So basically, asset is, if we understand it from the accounting definition, is something which is different as compared to what we understand in finance, right? For example, in a simple man term, or simple man or woman, okay, term, it's actually said asset is something that give you money. Okay, put money in your pocket. That is asset, and liability is actually something that take out money from your pocket. Right, that is liability. Right, so that is asset in terms of a very simple definition. Alright, but when we look at the in terms of the portfolio, there are two categories of assets. Okay, two categories of assets. The first category is real asset. Real asset. Asset sebenar. Okay, asset sebenar. Real asset is, what do you know about real asset? What do you know about real asset? Okay, there are two categories: building, factory, houses, real estate, right? Equipment, which is real, that produce real economy, right? That is we consider as real asset. The other assets, the other class of asset is financial assets. Okay, financial assets. So we have two type of assets. One is real assets, the other one is financial assets. Okay, but we look at the nature of our economy right now. Okay, 2/3 of it, of our, we call it income, or we call it assets, are financial assets. Only 1/3 or maybe 1/10 are real asset, are productive real asset. Okay, if you look at the balance sheet of the, let's say, household assets, household asset in Malaysia, for example, you can see that the real asset is quite small as compared to the financial assets. Okay, financial assets can come in terms of stocks, bonds, sukuk, right? In terms of treasury notes, okay, in terms of currencies, okay, unit trusts, everything that are considered, that are financially, what we call it, attached, is actually considered as financial assets. Whereas for the real assets are real estates, equipment, factories, and so on, right? Which produce real economy, right? And even though it's actually there are different categories, right? The financial asset actually depends on the real assets. Okay, for example, stocks. Okay, stocks, shares, right? Stock shares depends on the company performance. Okay, when you buy stocks, you only receive income. Okay, in terms of dividend, you only receive capital appreciation, right? You don't really, in terms of financial, in terms of the paper, you really you own a little bit of, let's say, Tenaga Nasional. Okay, but the real thing is that you do not own the Tenaga itself. You only own a portion, a small portion, right? So when you buy that financial asset, okay, you have actually the luxury, okay, to own a portion of the company, right? You don't have to establish one. You don't have to establish, like for example, KFC ke. KFC is still not in the stock market. Okay, it will be listed. Okay, in Bursa. I think it will be in August. Okay, fully. You can buy if you like KFC so much. You like to eat KFC, especially during Ramadan, right? So you can buy it, and then you can say that, hey, let's go to my restaurant KFC, because you own a portion of the share. Right? So you actually probably your portion is only the tables, right? A portion, or maybe a table, or maybe the aircon, but you are the owner of the company. So you don't have to set up it from scratch, right? So if you want to set up from scratch, then you have the real assets. You have the real, we call it, business, right? For the financial asset, is actually a derivation of the real asset. Okay, you have stock market, you have bond market, you have currencies, you have unit trust, you have so many things, right? So we have two type of assets. One is real, the other one is you can say it artificial, or probably yeah, artificial, but I rather like it to be called financial assets, because artificial is something like we can say is the one. Right, okay, right. So basically, that's a bit of introduction, okay, about what we are trying to do. We are trying to managing our assets, okay, because we are all going to be somebody who are literate, okay, in terms of our finance. We don't actually work for liabilities. Okay, we don't want to work until we end up our pension time, then we end up collecting liabilities. So we don't want to do that. That's why um, we are looking at managing our assets. Okay, we don't want to we still need to manage our liabilities, right? We still to manage our liabilities, because it's also a part of parcel of our life. We have assets, we have liabilities, but we too emphasize on liability management, but we do not care about our assets. At the end of the day, we end up liability, uh, liability, what you call it, pengumpul liability. All right. So portfolio management is actually involved decision that must be made by every investors, whether an active or passive investment approach is followed. Okay, in terms of investment, we can actually divide it into two. One is active investment, the other one is passive. Right. So passive is passive. You don't do anything. You just buy and then you hold. Right. Buy and then you sleep. There are some people say that, oh, okay, if I buy an asset, I will just, for example, stock. Okay, I will just mm, throw away the password. so that you cannot open your platform. So that when you buy it, okay, throw it away, wait until 10 years. So that is like passive. And then I don't think that is would be really reliable at the current state. Because if you are talking about stocks, okay, in the 1930s or 40s, it might be okay, because after we have a Great Depression, then we have a very uh, increasing market, okay, but we do have some volatility in terms of the financial crisis, the economic crisis, every 10 years, right? So basically, but the average, we call it momentum, is actually is going up, right? So it's quite difficult for you to just lose your password and wait until 10 years, right? So that is passive. The other one is active. You keep on looking at your investment, your portfolio. Sometimes you have to readjust. Sometimes you have to rebalance, right? Your portfolio, depending on the market. Okay, where is the market direction? And sometimes good companies might not be really performing well in terms of a certain market condition. So we need to maybe to can say cut loss, okay, or maybe stop loss, okay, trailing stop, okay, so that we will protect our capital. The idea is that we want income and we want to protect our capital. Okay, all right. So relationship between various investment alternatives must be considered if an investor is to hold an optimal portfolio. Okay, another thing that we will discuss is how to develop an optimal portfolio, right? An optimal portfolio based on different types of different theories. Okay, you can look at the modern portfolio theory, MPT, Markowitz theory. You can look at Black-Triano, and so on. There are many, we call it, theories that we can actually look at, right, and then see what will be the best, right? But if you are looking back, okay, before we go into portfolio management in the financial assets only, you have to look at the portfolio management comprising both, which is the real asset and also the financial asset. Because definitely we will have real estates, we will have our car, we will have our, which is real assets, right? And then we do have also our financial assets. Okay, and if we look at, for example, if we look at the way how we generate income, okay, there are three ways of how we generate our income. Okay, not cara menteri cakap you kena kerja dua dia kan. Okay, the first one I mentioned last week kan. The first one is active income, second one is passive income, the third one is portfolio income. Alright. Okay, now looking at your portfolio, alright, looking at your portfolio, basically we have our real assets and also we have our financial assets. So real asset might come from real estates, okay, might come from your factories, might come from your business and so on. Okay, the real assets. Okay, then that can be, we call it, we can consider that as passive income and active income. Okay, if you are working in a restaurant, then basically. But if you are owner of a restaurant or a factory or a manufacturing, then that will be passive. Then we have portfolio income, which is from the financial asset. You don't have to work. Okay, you just become an investor. Basically, both are investors. Okay, if you are real estate owners, landlord, right? You are landlord, you rent out your properties, okay, to tenants, then that is also considered as you are as investors, right? Except that the nature of investment is a bit different as compared to the investing in the stock market, in the bond market, or in the real estate, because the strategy is a bit different. But the idea is the same. You need to get income and capital appreciation. Okay, for both sides, from the real asset and also the financial asset, our target is income and also capital appreciation. Okay, income can come from dividend, can come from rental, cash flow, can come from profit from your business. Okay, and capital appreciation, it can comes from the appreciation of your stocks, the appreciation of your properties, okay, the appreciation of your currencies and so on. So two types of income that we can generate from our asset, our investment. Okay, capital and also dividend income or income, as we say, cash flow income and so on. All right. So basically, when we talk about portfolio management as a process, okay, is actually everybody can do it, right? If you follow the structure, everybody can do it by themselves. But if you don't have the knowledge, then it's quite difficult, right? So it integrates a set of activities in a logical and orderly manner, and continuous and systematic, encompasses of all portfolio investment with a structured process. Anyone can execute decision for an investors. So basically, we need to have knowledge. At first, we need to have knowledge. The first thing first is knowledge, right? Then only, if you follow the structure, then you can do it, because it's actually a structure. Process the 5 steps. You follow the 5 steps, then it will be okay. The problem might be in security analysis. Where do you want to analyze the securities? You're looking at your expected return, you're looking at the market return, looking at the beta and so on. So that is quite a lot of things that you need to understand, right? So alpha, beta, something that not all investors know about that. For example, if I've been in the stock market for quite some time, and some of the investors don't even know what is beta, what is alpha, what is, right? What they do is that only price goes up, you make money, right? Price goes up, then you make money. We don't actually know what is beta, what is correlation, what is alpha. But the best is that sometimes they make money. Okay, they do make money, even though they don't know anything about, I call it, all these jargons. Okay, I can say it's jargon, finance jargons and so on. But they do make money based on their strategy or their technique of buying and selling shares. Okay, and sometimes we can call them as traders, okay, not as investors. Okay, all right. Now, portfolio management as a process. Now, first we look at the objective, constraints and preference are identified. So we lead to an explicit investment policies. You need to have an investment policies. Okay, policy. Because, okay, now when we talk about this, it might struck to you, wow, I am just one individual, right? Do I have to have my own investment policy? This is a question I am posing. Do you need to have an investment policies for you to invest? Yes. What is it for? What is it for? To guide you. Okay. To protect your capital. Okay. So basically, even you are individual or the institutional, still have to have these investment policies for your own. Okay, for your own sake. Okay, for your own needs. So you need to have. Okay, what will be my objectives? What will be my constraints? What will be my preference? For example, the objective, you can look at your objectives. Okay, I want to invest in short term, or maybe long term, or maybe is it medium term, right? So looking at your objectives. Okay, maybe you want to invest because of your pension fund, or you want to go for your umrah, or you want to go for your hajj, right? So that is your medium term objectives, all right? So, and also looking at your constraint and so on. And then you have to we'll discuss about this a bit later. Okay, strategies developed and implemented, and look also at the market condition, asset mix, investor circumstances are monitored. Okay, market condition is very, very important. Sometimes it's very difficult for us to beat the market, but some of the investors can beat the market. That's why they set up their own portfolio. If you don't beat the market, you just buy index. So if you cannot beat the market, buy index, because index is market, right? So KLCI index actually being represented by 30 companies in Bursa, only 30. Last time it was 100. But now there are only 30 companies. Okay, has been combined to represent KLCI, Kuala Lumpur Composite Index. Kuala Lumpur, bahasa Malaysia, Kuala Lumpur Index, Kuala Lumpur, kalau bahasa Malaysia apa? Kuala Lumpur Composite Index lah. Index Composite Kuala Lumpur. Okay, Index Composite Kuala Lumpur. So only 30 companies. Okay, only 30 companies. So you buy index, then you are actually following the market. So you don't, because this is one theory saying that you cannot beat the market. Okay, that's why some unit trust or fund managers, they try to follow what is the market, what are the index. Okay, because if you look at, for example, unit trust managers, right? Okay, I have different types of fund that I'm going to offer. I have the growth, okay, index, growth fund, medium, low risk, and so there are so many funds that they are going to offer to you. So if you believe that you are going for the market, then go look into the fund that actually comparable with the market, okay, which is the index lah. Alright, and then portfolio adjustment are made as necessary. And now this is not the one that actually sleep. Okay, once you buy the stocks or whatever, you sleep until 10 years. So they still make adjustment, right? They still make adjustment, because I've been arguing with some people saying that, oh, we just buy this and then they just want to lose the password, throw it away, right? And then they want to reopen the platform 10 years ahead, which is not really advisable to be done, because your investment can be negative, because changes in the market direction, changes of the policy, okay, market risk, interest rate risk, currency risk, and so on. Okay, so we have this mentioned before, individual versus institutional investors. So basically, institutional investors maintain relatively constant profile over time, and then we have legal and regulatory constraint. Well-defined and effective policy is critical. Okay, that is for institutional. But for the individual investors, life stage matter. Okay, why do I say that life stage matter? Last week we have discussed that when you are young, you can what do you answer us? You can have a higher risk, right? Because you don't have any commitment that is too much, okay, imposed on you. But once you are getting younger and younger, right, you tend to be moderately low risk, right? You don't look at the high risk. You have like portion only of your assets, okay, in high risk. Okay, for example, maybe 80% in a real asset, 20% in financial asset, right? Okay, so because you start to later, like at your later stage of your age, you start to spend, okay, rather than accumulating. When you are still at younger age, you you really accumulate. You really work. You really go for it, right? When certain people, when they are at the end of the cycle, they start to spend. They don't want to accumulate anymore. They spend. They give, right? They start giving. Okay, giving to the grandchildren, right? Giving to the grandchildren. Okay, if you can notice that probably when you are their children, you don't get the luxurious thing that they are giving to your grandchildren, to their grandchildren, right? So when you are their your children, so you can see that, well, not because of they are, what you call it, they have preference over the grandchildren over you, but because their life stage, okay, has gone to that, because they tend to become more a spender, okay, more giving, right? So they have already done halas all the, what you call it, so it's time to give, it's time to spend, right? But the younger generation, okay, they want to accumulate, they are looking for more risk, more return, right? They can actually absorb higher risk. So probably their asset allocation might not be so much in the real asset because they can't actually afford to buy a house. Probably a house is might be too expensive at the moment, right? So probably more on the financial assets, okay, more on the cash savings and so on, tabung haji, then alright, and then stock market and so on. And risk is defined as losing money. As mentioned before, investment is not only making money, sometimes also losing money. Most of the time losing money, then something is wrong. Okay, all right. So we need to look at back at our how we want to select. But sometimes, yeah, some people, yeah, most of the time they are losing money. I don't really know about that, but there are strategies, technique that we need to employ, and then sometimes we need to find that strategy. Until that time, maybe we lose our money, but sometimes we need to learn from the people who make money, right? And then, yeah, market condition also plays an important role with the timing of our entrance into the market might not be correct. Okay, we are entering into the market when the market is not going down. So you cannot basically be in like in contrast with the market. When the market is going down, definitely it will go down. Okay, but if the market is going up, okay, whatever stock that you buy, for example, you make money, right? Okay, when the market is down, there will also be booming. Okay, and that's the time when you need patience. Patience. Inna Allah ma'asabirin. So basically, you need to be very patient. That is the mm, okay. There are two ways. One, you cut loss, okay, because probably you're going down again until it's the floor. Then you can buy back when it's the floor. But some investors, they will buy more. They will average down until um, it's time to the stock goes up. But that is if you have a lot of money. But you don't have a lot of money. Cut loss is one way, and then buy back at what you call it, at a very low price. But it depends also. But some people, they don't want to do that because they say that once they take out their money from the market, they are actually losing the compounding factor. They are losing the return they're supposed to get. But it depends, okay? It depends. So basically, it depends on a lot of things. First is our age factor. Our age factors, you want to make your objectives, right? Your bank account, a lot of constraints that we will mention about it also. Constraints, okay? Your objective, whether it's short term, long term, whether you want to use that money or not, right? Yeah. Low risk kan. Ha. Okay lah. Okay, this basically firstly is look at your asset allocation just now. Okay, you have your real asset and so your financial asset. What would be the percent of your financial asset you need to consider? So whether it's actually 40-40-60 ke, 50-50 ke kan? So basically because ASB is considered as financial asset. Okay, ASB. So depends lah. Okay, depends. At your level, you might want to look at whether because financial asset still have risk higher than the real asset, right? Okay. Is okay. This actually you are using leverage. Okay, leverage theory. Okay, leverage theory is using other people's money, right? For you to gain income, profit. So if you want to know whether it's actually okay or not, basically your income must be more than your cost. So your income should be from the ASB dividend, right? Must be more than your cost of your financing, ASB financing. So if you have more, alright, then go ahead. If it is lesser, it's just like you are paying, it's like it's a liability. Because you have to pay every month. It's better for you to save rather than to use the financing. So you need to do that. You need to calculate what will be the cost and as compared to the income. If the income is greater, okay, because you are using other people's money, okay. But if the income is lesser, you look at how much is the we call it the discrepancies, right? If you can think that you can afford it, okay, because you want it to use it because not because of income but because of discipline. Okay, you want to make it a discipline for you to to save. Alright? So then you look at it. So basically, for example, if the discrepancy of the shortage is 50 ringgit, so 50 ringgit is actually the cost of you saving. It's compulsory for you to save. Okay, because if you do it yourself, you might not be doing it, right? But if you ask the bank to do that, then that we call it the shortage of 50 ringgit is actually the cost of you using that facility. So every month you pay 50 ringgit lah maksudnya. So at the end of 10 years, the total amount that you paid, okay, for you to be disciplined, is that total. But you need to calculate that, okay, whether it's actually higher the income as compared to the cost. Alright, now characterized by personalities. Personalities. You like high risk or low risk, depends on your personalities. Some people they like bungee jumping. Kan? Do you like bungee jumping? No. Some people like rempit. Why do you think they like rempit? Right. Some people rempit in the stock market. They rempit in the stock market. Okay, high risk, but no problem. 2 or 3 minutes, 5 minutes, go rempit, boom. Then you just take out. So that is rempit in the stock market. Okay, high risk. Okay, but they do it 5 minutes, 10 minutes, sometimes 1 hour, right? Just to make money. They call it rempit lah. Right. Huh? Tapi dia tak adalah Superman, kan? Dia tak adalah Superman dekat stock market tu. Dia cuma dia tengok mana stok yang ada potensi tu, dia masuk sekejap je. Dia memang FIFO, fast in, fast out. Okay, fast in, fast out. Sometimes make money, sometimes lose money. Okay. Bungee jumping stock market tak adalah ubat. Itu pandalela kan. Itu pandalela. Okay. Dia macam ni. Better if you want to do that, you are a trader. You are a trader and also you are like a very trader, full-time trader lah normally. Full-time trader. Okay, the idea is that if you are a trader, okay, let's say you have 5 days of trading, okay, if you can get 3 days of profit, 2 days of losses, or 2 days of not making money, then it should be okay. Or maybe it must be more profit as compared to loss, because losses is inevitable. I made losses yesterday, right? About $1,000 ringgit, sorry, 1,000 ringgit. So today I don't have the opportunity to make more money. But sometimes I make money, sometimes I don't make money. But at the at the at the 20 days, for example, you must make more money as compared to you make loss. Don't try to cover, because sometimes the price is not as what you expected. Right. You don't know. Have you been trading before? Few years back, you are in the stock market. Stock market or in the which unit trust? Stock market. Okay, you are in the stock market. So basically, you feel. Is that in the there's not the stock market, right? There's the global market. Global market. I have lost so much money. Right. So, but I keep on. So basically, losing money is one thing, because if you are trading, but you are investing, then it probably, because for example, this is from my experience, my asset allocation is more towards properties. 80% or 95% of my asset allocation are properties and other things, real assets. Only 5% is in the stock market. Is exactly only 5%. So that 5% is just like my because I'm teaching investment, I'm teaching finance, so I need to know everything. I need to experiment everything. I try this, try that, so that I know, okay, this is how derivative, this is how option, this is how. So sometimes make money, sometimes lose money. Yeah, correct, right? But uh, you basically, okay, if you think that the global market is not really for you, then you can look at the Malaysian market, which is more nearer to you as compared to the global market. You need to know about the global economy, about the global what's happening in the world, the news, and so basically the global market is more volatile. One day, okay, you make money, the other day you can lose money because they are too volatile. Example is the crude oil. Okay, crude oil, WTI, Brent oil, okay. So there can be a spike, a very long spike, okay. You can make a lot of money within few seconds, few minutes, right? I made a lot of money, not a lot, just a small amount of money, okay, but a lot, a big percentage, okay, because we look at return in terms